Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little bit of money. My job is not just to entertain you, but to educate, to do some teaching. That's always been the case, hasn't it? So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. This setup's a great one. That's what I see right now. And I want to get a jump on it as Mad Money winds down for our 20th year. The chief pillar, takeovers and acquisitions. They're going to be an extraordinary force for the bulls in 2026. I'm going to try to get the right theme. They won't necessarily move the averages in a visible way. Like today, when we got some real takeover news, but it didn't play an obvious role. Dow gaining 228 points, S&P rising 0.64%, NASDAQ advancing 0.52% as the Christmas rally continues. But I want to really get into this because I'm so worried you're going to leave. I don't want you to leave this market. I know it's high. I know people say it is. But there's things happening. There are mergers and acquisitions that are really special to you. Some don't do that much. I get that, but others do. The kinds you're going to see in 2026. They're strategic, they're valuable, and they're going to make you a lot of your money. Before I go into the specific deals, though, let me tell you why these transactions are so important to you and why you must stay in the market to profit from it. First, the stock market is fundamentally about supply and demand. If you increase the number of shares, then the averages may have trouble advancing. Periods of great stock issuance can lead to uncomfortable moments. We've seen this. There may not be enough money coming in to sop up the additional supply. So what happens? The market goes down, a bear market. But takeovers, they can temper the market's endless stock issuance. Now, I think we're actually going to need that because, see, I also expect a very robust issuance year, with a few potential blockbuster deals, one from OpenAI and one from Elon Musk, flooding the zone, so to speak, with new stock. It could be hard to overcome that much new supply. Fortunately, public companies keep buying the private companies that are held by private equity. That's good. We don't need these potential IPOs. Tight supply means higher stock prices. Second, I know that the market did well under the Biden administration, but I believe that most of that advance occurred despite the president. I say that because Biden didn't care much for the stock market. I knew that. And he had the single most dogmatic anti-merger individual running the Federal Trade Commission that I've ever seen. Lina Khan worked hard to twist logic to try to veto almost every deal. Now, in fairness, she genuinely believed all mergers were inherently anti-competitive and punitive to someone in each case. But that attitude removed a key way for you to make money in the market. The administration, this one, much more friendly. So far, we've seen a propensity to believe in deals, recognize their value to the market, the customers, the shareholders. The previous FTC head really didn't factor in the value to you, the shareholder. That's not the case anymore, and I salute that. Third, the markets awarded some of the acquiring companies with a higher stock price. Now, that rarely happens, but now it's happening right now. Somewhat consistent with the incredible market that I see happening. Finally, CEOs are beginning to realize that there can be many gains from artificial intelligence, but the gains come with turmoil and stress. You may be able to fire a huge percentage of people and replace them with AI, but the disruption can cause a company to miss its quarter or maybe many quarters, punishing shareholders. It's better to be privately held. The most salient takeover battle right now is the contest for Warner Brothers Discovery. Here we have a public company that's more like a private company, Paramount Skydance. I say that because its bid is personally funded in part by the fifth wealthiest person in the world, Larry Ellison. His son runs the business. In the fight for Warner Brothers, and Paramount is going against Netflix. Today we get more assurances that Larry's willing to provide backstop financing for the acquisition to the tune of $40 billion. But Netflix wants it, and you know what? I think Netflix has the blessing of Time Warner board. Unless Ellison comes back with a huge amount of money, I don't think they get it. What I care about is that there are two bidders with big pools of capital trying to get this one asset. Netflix isn't known as a deal maker, but they've surfaced out of the woodwork. Ellison personally isn't a deal maker either, though his principal employer, Oracle, has been known to make deals. Larry's standing up for $40.4 billion, a personal guarantee. Let's not lose this forest or burn it down for the sake of the trees moment. This stock, Warner Bros. Discovery, was trading at $7 when I had dinner with CEO David Zaslav just 7 months ago. And he said the company's worth $34 a share. You know what? I think he's going to be right. Everyone keeps talking about how expensive stocks are. Was Warner expensive at $7? Isn't that the real takeaway? It turned out to be dirt cheap. Take that, bears. Or how about the deal this morning where Trian, the fund led by Nelson Peltz, and an outfit called General Catalyst Group are taking the storied money manager Janus Henderson private for $7.4 billion, which is 18% above where it was trading back in October, when Trian and its partners made their first offer for the company. The big story here, Janus knows that it wants to move aggressively using AI to come up with great things for investors. The performance for most of their funds has been stellar. And if you have money with them, you won't even notice these moves they're going to be making that I'm about to talk about. But Janus doesn't feel it can make these kinds of moves with AI without crushing its stock as long as it remains a public company, which is why it wants to go private here. I think this deal is the template for dozens of companies going private in 2026. Then there's a whole nother template. Cintas trying to buy UniFirst, an ongoing saga that has the number one uniform retail company, Cintas, trying to acquire the number 3 player in the same business. There was an indication of interest via Cintas in 2022. Then in January of 2025, Cintas formalized a generous bid that was rejected. Now it's back with the same bid, $275, which is a 64% premium to where the stock had been trading. But get this. This is what's important. Cintas is so confident that the regulators will bless this deal, that they're offering a $350 million reverse termination fee, bear with me, on this $5.2 billion transaction. Therein lies what's most interesting. If Cintas had offered a termination fee under the old FTC, there was a good chance they would have had to pay it, because Lincom would have eagerly blocked this kind of deal. But this administration wants strong companies that can extend their reach, confident that others will rise up and challenge them. If you're a client of UniFirst, you actually might, of course, may worry that your uniform bills are going to go up, and the government's going to look at that. But Cintas, they're not stupid. It will lose clients if it raises prices too much, as there's always someone willing to come in underneath. UniFirst has been adamant about staying independent, but it's a public company, which means it's always for sale at the right price. Frankly, I think a 64% premium seems to me to be the right price. Finally, there's the everybody wins kind of M&A. This morning, Stanley Black & Decker sold its aerospace manufacturing business, Consolidated Aerospace Manufacturing, to Howmet, a crackerjack aerospace company, for $1.8 billion in cash. This is a terrific deal for Stanley Black & Decker shareholders, because that company needs to repair its balance sheet, hence why the stock rallied 3%. Howmet, which we affectionately call How I Met Your Mother, can become an even bigger player in aerospace, which is why that stock jumped $4.68. The bottom line, these are all fantastic templates. 2 acquirers with stocks that go higher, a buyer confident that it can merge the number 3 with the number 1 in the same industry, and a company that can't get AI right without hurting a quarter or 2 profits. So why be publicly traded at all? And then finally, their Stanley Black & Decker aerospace business turned out to be worth more than anyone expected. New patterns, new methods, new money. What's not to like? Mark in Massachusetts. Mark.
Jim, the Patriots are back, but when is Costco going to be back?
I was at Costco this weekend trying to check it out, trying to figure out what the heck is wrong. I think what's wrong is the stock got too high. I would have thought at 41 times earnings, it's done going down. That was wrong. We did sell half the position. I can't believe I sold any of it for the Charitable Trust. We had to. I don't like the re-ups, what we call the people going back to the club and getting a new card. And I've got to tell you, a replacement card. I've got to tell you, I don't like it still. I had a great time at Costco yesterday with my wife, but that doesn't necessarily translate into people re-upping at a better rate. I am concerned I might sell the rest. Let's go to Nick I know that's big. Let's go to Nick in Connecticut, please. Nick.
Hey, Jim, I'm a first-time caller, a long-time listener and club member. Thank you for everything you do. I really
thank you. Thank you for calling. Thank you. How can I help?
Absolutely. I bought Home Depot in September expecting some upside from the anticipated Fed rate cuts, but the stock is down after those 2 cuts recently. Should I buy more, sell, or hold?
Yes, I would buy more. It's a big position for my Charitable Trust. Why would I buy more? Because we are going to get more rate cuts, particularly because the president wants them, and he's going to pick someone who, forget all this nonsense you hear, they're going to cut rates dramatically. And you have to be in Home Depot for that, because it's the single best way to play a turnaround in housing. It's the only one housing-related stock that we have in the trust, and I feel very good about it. Right. As we head into 2026, I think takeovers and acquisitions will be the chief force for the bulls. And to that, I say, what's not to like? Oh, man, money tonight. We're revisiting our 25 questions for 2025 and seeing how the market stacked up to our expectations this year. First, I'm looking at the macro picture to see how the economic backdrop affected your portfolio. Then I'm going sector by sector, from commodities to consumer packaged goods, and I'm getting a read on the REITs when I sit down with the CEO of Prologis for the last time. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
At the very beginning of the year, we were in this three-part segment on my 25 questions for 2025. Look, I came up with 4 big macro questions, 1 question for each of the 11 major sectors, and, of course, 10 tech-specific questions. So now that the year's nearly over, let's talk about the answers. First question, does the yield on the 10-year Treasury go to 4% or 5% first, or neither? At the time, the 10-year was sitting at just over 4.5%. And this is one where we got a definitive answer because the 10-year went to 4% first. Given that so much wealth from housing to your portfolio is related to the 10-year, we have to follow it like a hawk. What happened in 2025? Specifically, the 10-year broke below 4% briefly in that post-Liberation Day washout last spring, setting a 52-week low of 3.88 in April. More recently, now that the Fed started cutting short-term interest rates, the 10-year has touched the 4% level a couple times, first in mid-September, then in mid-October, and then again in late November. Of course, the bulls would feel better if the 10-year had fallen below 4% and stayed there. But that's not the case, with the benchmark yield currently sitting at about 4.15%. Don't let anyone scare you. That's fine. Fine for stocks. And there's a lack of consensus about how much help we can realistically expect from the Federal Reserve next year. Not even the members of the Open Market Committee can agree on the number of rate cuts that are needed. Say nothing about investors or people betting in the predictions market. The second question for 2025, we wanted to know whether the labor market would remain tight. And here the answer seemed to be a definitive no. We went from adding over 100,000 jobs per month in the first few months of the year to averaging around 17,000 jobs added over the course of the past 6 months, meaning June through November. That's actually kind of pathetic. In June, August, and October, job growth was actually negative. And that, I'm going to call that bad. Meanwhile, the unemployment rates rise from 4% in January to 4.6% in November. That's not good either. Now, the silver lining here is the fact that the labor market weakness has allowed the Fed to remain our friend. But to answer the question from the beginning of the year, no, the labor market has not remained tight. Third question, we asked what's going on in Washington, specifically what's going to happen. Now, that was a catch-all question. What I was really asking was how the Trump administration would impact stocks. In retrospect, though, maybe I should have been more detailed because Trump 2.0 cuts in many different directions. Long story short, the NASDAQ indices up over 21% for the year. That's incredible. S&P up almost 17%. I'll take it. And the Dow up close to 14%. The Trump administration has overall been just fine for stocks. Of course, it didn't look that way initially. The year began with this huge pullback, with the S&P falling 21% in anticipation of the president's increasingly hardline tariff agenda. And in response to those initial Liberation Day tariff rates that were announced in early April. But once the president reduced or postponed most of those tariffs, the market bounced back quickly. It spent most of the year since then rising gradually. Whether you love him or Trump, or whether you hate him, look, if he does something that truly panics the market, he tends to roll it back. Now, the only major piece of legislation out of Washington this year, the One Big Beautiful Bill Act, didn't impact stocks much yet. In fact, some of the specific policies in the OBBBA concerned immediate expensing of capital investments might actually be underappreciated as a huge catalyst as we enter 2026. It could boost earnings dramatically, but no one's talking about there. I just did. And the government shutdown this fall, the largest, longest in history, 43 days. Well, that didn't hurt that much, did it? Not stocks. Once it ended, we bounced right back. I want you to remember that because I'm going to tell you there are going to be more of them. Of course, there's a ton of controversial stuff happening in Washington at any given moment, but at the end of the day, it's just not that relevant to the market. Maybe you think the Trump administration is pushing the boundaries of executive power. Look, but I guarantee you that Wall Street doesn't care either way. Fourth, the last big macro question we asked was whether corporate earnings would keep growing like we expected in the end of 2024. As a reminder, at the beginning of the year, when I first posed these questions, the consensus expectation was that we'd see about 12% earnings growth for the S&P 500 in 2025, followed by another 12% of earnings growth in 2026. Those expectations were at the heart of the bull thesis for this market coming into the new year. So how does that look? Well, to start, the final tally for S&P 500's 2024 earnings ended up slightly. Like it will come in slightly lower than anticipated, more like 10% instead of 12%, but not for bad reason. In fact, the S&P 500 earnings projections for 2025 slightly higher than it was at the beginning of the year on an absolute basis. Earnings expectations for both 2025 and 2026 came down after the president's tariff rollouts, but bottomed in May and June. Then we had strong second and third earnings seasons, so the estimates have gradually climbed back to levels that are now above what we were looking for at the beginning of the year. The other big thing to note here is the fact that the earnings expectations for next year are higher. Rather than the 12% earnings growth that Wall Street was projecting for 2026, now we're looking for nearly 14% earnings growth next year. That's going to be a very high benchmark. Of course, those are just estimates, not something you can take for granted. For the market to keep rolling in 2026, we're going to need to hit that 14% collective earnings growth forecast. But looking at these numbers, you can see why the market's had another strong year of gains. At the end of the day, earnings growth is the single most important determinant of your stocks. The direction. And the fact of the matter is that earnings growth outlook has gradually gotten better over the past 12 months. So the bottom line, there you go. Those are your answers for my four big macro questions that I asked at the beginning of the year. But we're far from done. Stick around because after the break, we'll revisit our sector-specific questions and see how those have worked out in 2025. Net Money's back after the break.
Coming up, Cramer's answering more of our 25 questions for 2025 as he's taking you sector by sector and seeing how they each fared this year. Next.
Coming into this year, I posed 25 questions about the market to figure out where we might be headed. And now that the year's almost over, I'm giving you the answers. Before the break, we already went over the first four big picture questions. Now I want to cover the next 11, and it's one for each major sector. First, for the communication services sector, which is an odd amalgam of a group of, including, say, both traditional telecom companies, as well as some gigantic tech companies like Alphabet, Meta, Platforms, and Netflix. I wanted to know if the advertising market, the most important profit center for the first two of those I just mentioned, would hold up in 2025. But as it turns out, I was asking the wrong question. Sure, the advertising market's been fine, but I should have been asking about how the mega caps would hold up in the race for AI supremacy. Alphabet's made great strides with the release of Gemini 3. One reason its stock's up more than 60% for the year. Meta, on the other hand, hasn't been able to convince Wall Street that its AI bets will pay off yet, which is why it's only up 13%. Maybe I should have been more curious about M&A here, because some of the biggest winners in the group are indeed takeover targets. Think Warner Brothers Discovery, like I talked about at the top, and Electronic Arts about to close. For the financials, I asked if there'd be a tangible benefit from the deregulation that we expected once the Trump administration took over. And here I think it's a clear yes. The banks have been solid performers this year, but the investment banks have been a bonanza, and that's all about deregulation. Goldman Sachs, a favorite of mine, a huge position for Mike Chappell Trust. Join the club. You can find out more. It's up 57%. Morgan Stanley's up 43%. JP Morgan's up almost 35%. These companies earn a lot more money when the White House isn't blocking mergers or heavily scrutinizing new IPOs. Keep an eye out for another big position in the trust. It's Capital One, COF. Now, it's the credit card company. It's up about 38%. I think it's going to be a monster year in 2026 for these guys. For the consumer discretionary sector, we asked whether the consumer's starting to get tapped out. And almost 12 months later, do you know the debate is still raging? In the middle of the year, it sure looked like the consumer was sputtering. I think it's fair to say that lower-income consumers are clearly not doing particularly well right now. Consumer sentiment obviously isn't in a great place either. I wish that would change, but it's just a gloomy time. We can't seem to bust it. However, the market's been feeling much better about consumer stocks in recent weeks after we got a terrific series of earnings reports from some big retailers, followed by some strong Black Friday numbers and another rate cut from the Fed, although there's a lot of talk about how the last few weeks have been not so great. I don't want to take it like that. You just have to say it's been a pretty good season. For the tech sector, I asked if the AI investment theme would keep roaring, and that's a clear yes. More on that later, because we posed another 10 questions just about tech alone. For the utilities, we asked whether they could actually meet the rising need for electricity from all these new data centers. The Utes are in growth mode again from all this power demand, and I still feel pretty good about these stocks. Even as the group's up over 12% for the year, I do worry about rates going up and maybe some of the ratepayers rebelling. For the industrials, we asked which subsector would prove most durable. And the answer in retrospect is that power and electrical equipment continues to lead the way, right alongside aerospace. That's something I saw coming. What's maybe more interesting, some of the subsector groups that have performed much better than I thought at the beginning of the year. Think defense, which has overcome the tough talk about cutting Pentagon spending and done just fine, including today when the group just went nuts to the upside. And don't look down, but the transports have been very strong of late. The end of the freight recession, boy, does that ever bode well. All aboard! For the entire market in 2026. For the consumer staples, we asked if the packaged food group could overcome the wall of worry created by the GLP-1 drugs. This one's straightforward because the answer is a plain no. Packaged foods is really one of the worst cohorts in the entire market. The broader consumer staple sector has been the second worst sector out there. Individual food stocks like Campbell's, Lamb Weston, Conagra brands, they're all down about 30%. At some point, the valuations and the yields for this group might become too compelling to ignore, but we're not there yet. I talk a lot about how those stocks used to be called safety stocks. Now they're safety last in how to make money. I was pretty brutal about them. I'm actually proud that I got that right. For the energy stocks, I asked if industry discipline would remain once a new drill era began with the return of the Trump administration, and the answer is no. They couldn't stay disciplined. As I predicted, domestic crude oil production is up, domestic natural gas production is up, and shares of most oil and gas producers are therefore down. Some of them down big. If you want energy exposure, I suggest the pipelines and similar infrastructure plays. Here I'm talking about something like a One Oak enterprise product. Basically anything that's not levered to actual energy prices. For real estate, well, I asked about if we'd see elevated store closings because of more retail bankruptcies. And this is another place where I think I was asking the wrong question. We had very few retail bankruptcies, and most retail-focused real estate investment trusts did just fine, despite all the sturm and drang we heard about. The power of the retailers to stay afloat is just much greater than people realize. It will always be that way, I think. There's just not enough development to make it so that there's a scarcity value here. That said, real estate ended up being still the worst-performing sector of the market this year. The biggest headwind seems to have been interest rates, though, not failures. And interest rates, they didn't come down enough, not enough to get investors excited about the group, at least. We need more relief from the Fed and the bond market if real estate's going to make a comeback. For healthcare, I asked how much of an impact the new HHS Secretary RFK Jr. would have an impact on the group. And I got to say, for much of this year, his arrival in Washington did have a negative impact on the healthcare cohort. But the healthcare stocks have come roaring back in the past few months. While some of that's from a pure flight to safety trade, part of it comes down to a tacit acknowledgement that RFK Jr. hasn't really impacted the industry all that much, at least not yet. Everything from the often-maligned middlemen like McKesson and Cencora to the much-vaunted Eli Lilly just roared this year. Finally, I asked a question about the materials sector. Could prices for certain commodities like non-precious metals and certain agricultural goods, which entered the year at very low levels, find a way to rebound? In general, commodities have firmed up this year, with the Bloomberg Commodity Index up over 11% year to date. That's inflationary. Under the surface, though, we've seen a totally mixed bag. Precious metals are way, way up. Silver, gold, holy cow. Crude oil, way, way down. Regular metals generally up with the help of tariffs, but a lot of crops and chemical stocks are very bad. That explains why we've seen a middle-of-the-pack performance overall for the materials group, which is up about 9% for the year as a sector. But within that, we've seen huge disparities, 40% plus declines for chemical companies like Dow and Lyondell, but also 40% increases for companies like Nucor and Steel Dynamics. Didn't see these before, but you know what? I should have pushed harder on Nucor. I always knew that was a good one. Bottom line. Well, that's where we stand with our questions for the 11 major sectors, and we've now covered our first 15 questions for 2025. After a quick break, I'm going to be back with updates on our last 10 questions of the year, which were all about tech. But in the meantime, let's take some calls. Let's go to Mark in Illinois. Mark.
Oh, yeah, Jim, from the home of the Chicago Bears.
I'm liking that, and the Bears look real good. Congratulations to you. I hope they go pretty far. Not too far, but pretty far. How can I help?
Hey, listen, I'm looking into, by the way, got your book, love it.
Thank you.
Love your book and love you. Been watching since you started.
Trying to tell stories. Stories. Go ahead.
Love it. You got such integrity. I love it.
Thank you. Thank you.
I've been got into Rivian around 17. Looks like a lot of good news going through the pipeline. What do you think the prospects are?
Rivian, I'm a balance sheet guy. This has had a major move. It's been terrific. I think some of it is a short squeeze. There's a very big short. I want you to take some off the table and then let the rest run, because in the end, I care more about maintaining gains when it comes to the heavily speculative stocks that are losing a lot of money. Let's take some off the table. Rest run. And thanks for the kind words about how to make money in any market. Now, some of the sectors surprised us to the upside this year, but for some sectors like consumer staples, the jury's still out. And for the foods, let's just say safety last. Much more mad money ahead. I'm continuing my year in review by honing in on the sector that might have defined 2025, and that's technology. Then what's the outlook for real estate in 2026 after a year full of rate fluctuations and economic uncertainty? I'm finding out with the CEO of Prologis, an old favorite of ours. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Like I mentioned earlier, at the beginning of the year, I posed 25 questions for 2025, and tonight I'm rounding up the answers. We've been through the first 15, and now we're down to the final 10 questions that are all about tech. The 16th overall and first tech-specific question I asked was how the AI infrastructure trade would evolve. And, well, I really don't have enough time to answer that one. For the first 9 odd months of the year, the AI theme grew beyond anyone's imagination. But for the last couple of months, Wall Street started to balk at the size of some of these spending commitments for the data center. I don't blame them. I think this new, more discerning phase will ultimately be positive for the market, though, even as now makes it a lot tougher to pick winners. Next, we asked who will be the initial group of AI software winners. In retrospect, maybe that question should have been, will there be any AI software winners? With the exception of Palantir, which I still like very much. The breakdown in enterprise software stocks this year has just been nothing short of brutal. The fear is that customers will be able to develop more of their own software with the help of these new AI platforms that are very good at writing code. Now, I'm not quite ready yet to give up on some of these companies, like Salesforce, which is now selling for just 20 times next year's earnings estimates. But it would help if their Agentforce AI platform keeps putting up good numbers. Stock did close up $4.72 today. That was a nice move. Question 18. I asked if the AI PC theme would ever materialize, and the answer to this one is sort of. Dell and HP have been reporting better numbers for the PC divisions in recent quarters, but Dell's stock's only up 10% this year, and HP's down almost 30%. Don't buy. Any device with an internet connection could be an AI device, so I don't see the real appeal for the AI PC sales pitch. The PC refresh thesis, it was a bust. For question 19, I asked if some of the more cyclical semiconductor names could start growing, and that turned out to be a big, fat yes. Do you know that 4 of the top 5 performers, the entire S&P 500, SanDisk, Western Digital, Seagate Technology, Micron, are memory chip makers, all more than 200% year to date? Now, these are inherently cyclical stocks that come down once more production comes online, but we got a shortage of semiconductor capital equipment, too, so these can keep booming. This thesis was the #1 propellant of 2025, and those it touched roared right into the close of the year. Very few people saw that coming. Separately, for question 20, I asked if unprofitable growth names would remain hot. And yes, they stayed hot for about 10 months, at which point they went out of style on the Wall Street fashion show as the year of magical investing came to a dramatic end. I also asked if some of the legacy tech giants like Cisco and IBM could continue the better performance they've been putting up. And I'm happy to say that by and large they have. Cisco's climbed nearly 32% year to date. About 3 weeks ago, the stock closed at a record high for the first time since March of 2000. Great win for the CNBC Investing Club there. Meanwhile, IBM's up more than 38%, trading at record highs. It's still cheap, by the way, and it still should be bought. For our 22nd question, we asked if the cybersecurity stocks would remain unassailable in 2025. While the group has held up okay this year, I wouldn't call it unassailable. The two that the trust owns, Palo Alto Networks and CrowdStrike, are up 3% and 41% respectively. And across the entire range of cybersecurity names, there's a lot of variation. I still believe this is a powerful secular growth story for 2026 because businesses need to protect themselves against hackers. But there are going to be winners and losers within the industry, which is why I urge you to stick with the best of breed. I still think that's Palo Alto, but more importantly, it's CrowdStrike. I also asked a fun question. How about this robo-taxi race? How's that going to shape up in 2025? At the time, I thought that Alphabet's Waymo was the leader, but I said that Tesla had a good chance to catch up with Elon Musk so close to the president. Well, as we exit 2025, Waymo's clearly still the market leader, and its success is yet another reason to like Alphabet, one of the best performing stocks of the year. Although I'm mindful of that San Francisco power outage story that was a big Waymo setback just this weekend. Tesla's robo-taxi service, meanwhile, is making progress, albeit at a slower pace than Waymo. And Musk had a high-profile falling out with the president last spring. Still, that hasn't held back Tesla's stock, which has been roaring for months. It is a horse. At this point, I'm wondering if robo-taxis will be a duopoly. If maybe there's another contender, I don't know, Amazon, Zoox, or Uber with some self-driving tech partners. But I think right now it's Waymo to win. I also asked what the impact of President Trump's trade policies would be on tech, and by and large, this hasn't been a major issue. There were times that tariffs on China and India looked like they might impact Apple, but the company won exemptions by making large domestic investment commitments. I say, Apple, own it, don't trade it. Maybe you could argue that NVIDIA was held back by a ban on selling even dumbed-down AI chips to China, which was initially partially repealed recently. But with NVIDIA still up more than 36% for the year and China basically completely excluded from their numbers, it clearly didn't do that much damage. It could be upside, too, if they ship that H200 to China this spring, which is what press reports indicated earlier today. NVIDIA, I say own it, don't trade it. Finally, I wondered how President Trump would help the cryptocurrency ecosystem, given his much friendlier attitude toward crypto than his predecessor. Now, there had been some legislative progress here. The Genius Act, which is related to stablecoin regulation, signed into law in July. I'm sure the industry appreciates that President Trump's SEC doesn't seem as hell-bent to prosecuting crypto malfeasance as Biden's. But looking strictly at crypto prices, it's tough to say that the Trump year has actually been all that good for the space. Bitcoin stands at about $88,000, down about 30% from its early October high, and even down slightly from the $90,000 level it climbed to right after the 2024 election. I wonder if crypto ends up being like the oil and gas sector under Trump, where the administration saying have at it is ultimately bad for prices. Time will tell. I still like crypto as a hedge, though. But the bottom line, I hope this look back at our 25 questions for 2025 has been useful to you as we head into 2026. You need to know where we came from before you can figure out where we're headed. Then Money's back after the break. It is time. It's time for the lightning round. Everybody, that's about our call. You say my name is Tucker. Tell about buy, sell, sell. Just because I know the core stock question at the time I stay to play it. Be a play to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Stephanie in Rhode Island. Stephanie.
Hey, Jim. This is Stephanie in Rhode Island.
How are you?
I'm fine, thank you. Merry Christmas.
Same.
I have owned Network Appliance for over 25 years, and I'm just curious whether I should continue to hold on to it.
Well, I think it's an okay company. It's storage management. That's a good business. Not a good year this year. I wouldn't mind if you trim some and got into some more exciting stocks I shouldn't say exciting, more investable stocks like we have and how to make money in any market. Let's go to Dylan in Connecticut. Dylan.
Booyah, Jim. Thanks for taking my call.
Of course. What's going on?
We spoke in September about this company, and since then, they have posted their first ever quarter with earnings. The stock soared on the report, but since pulled back. I would like your thoughts on Rubrik Inc., ticker RBRK.
Oh, my God. I think Bipple's doing a fantastic job. I can't say enough about how great the trajectory of this company is. I think you should own it. Continue to own it. Let's go to Richard in California. Richard!
Hi, Eddie. Your book is excellent. It's a must-own. I gotta say, I love it. It's excellent. So
Thank you.
Joe started new coverage. Yeah, sorry, I'm cutting you off. So Counterfeit Joe started new coverage on the AI company with a strong buy, $31 price target. I did a deep dive, and I like what I see. It's Gorilla Technologies. What do you think?
I don't know Gorilla Technologies. It is a small cap stock that I've not looked at. We're going to have to take a harder look at it because it is a little bit lower than our size parameters allow. Let's go to Todd in Ohio, please. Todd.
Hey, Jim, Patterson UTI. It's been a UTI for the last year.
No, we're not. No kidding. That's a good use of that term. Oil and gas is just a flat out no on this show. We are just not. We've not recommended those stocks for a very long time, and we're not going to do it this year. Let's go to Greg in Washington. Greg.
Yeah. Hi, Cramer.
Hey, Greg.
I wanted to ask you about Dynex Capital.
Yeah, now this is another one. I do not know these guys. Look, I think it's okay. Look, there's a lot of companies. It's a REIT. I don't follow all the REITs. I'm going to have to do work on it and come back to you. Let's go to Rick in Florida. Rick.
Booyah, Mr. Cramer.
Booyah.
First I want to say, booyah. First, I wish you and your staff a happy holidays.
Oh, thank you. Right back.
Not a problem. So the reason why I was calling is I know that you're a big fan on the streaming media when it comes to companies like Netflix and stuff like that.
Yes.
But I want to get your opinion after the acquisition with Disney, and they changed up a little bit of their business plan for Fubo.
For Fubo's had a big run, and I don't think there's any need to pile on at this price. I think it's just too high. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
So how do we feel about e-commerce as we head into 2026? Well, that's a question for Prologis, the real estate investment trust focused on logistics, mainly warehouses and fulfillment centers for e-commerce, but they got a big data center kicker. Here's a company that reported a strong quarter in mid-October, but it's about to have a big management transition with co-founder and longtime CEO Hamid Moghadam stepping down at the end of the year. He's been on our show since 2012. He is staying on as executive chair, though. Effective January 1st, the current president, Dan Leder, will take over as CEO. So what does this mean for the business? Let's check in with Hamid Moghadam. He's the co-founder, chairman, and outgoing CEO. I can't even believe I have to say that. Mr. Moghadam, welcome back to Mad Money.
Thank you, Jim. I hope you're well.
Oh, and I hope the same for you. I want to wish you well and great health. New year coming up. And mostly, I need you to impart some wisdom because you've been spot on now for 13 years with us. Where are we in terms of what you've seen in terms of the revolution, the need for warehouses, e-commerce, and whether business has caught up to your vision? Because you were about a decade ahead of everybody.
Well, Jim, that's nice of you to say. I think the business has evolved in a great deal, and maybe e-commerce is the latest aspect of it that has changed. But if you really roll the clock back to 42 years ago when we started this business, the real estate industry was a highly fragmented business. It was all very opaque and in the private market. It was actually mostly financed with tax deals. And the idea of global companies serving global customers on a scale that we have been doing, and it being available to the average investor through a REIT structure or a public REIT structure was unheard of. So I think it depends on which aspect of it you want to focus on. But certainly the business, the format, pretty much everything has changed in the last 42 years.
Why don't we talk about durability? Because that's what our investors want. They want to be able to be consistent. They want to be able, of course, to compound, because compounding is the best way toward wealth. Prologis has been an amazing compounder. First stock that I followed that bottomed during the Great Recession. How about the durability of what you've established and what you see in the future?
Of course, our business is ultimately based on the success of our customers. We collect rent, and hopefully over time, because of places we select for investment, those rents grow and earnings grow along with them. So it's a pretty simple business if you really look at it. I mean, the dividend yield is somewhere between 3% and 4%, depending on the day. And the growth rate over time has been in the high single digits. So that is a pretty good return in my book on a consistent basis. And of course, there are times that it's below, there are times that it's above. But we're never going to be the growth stock that tomorrow you can triple your money in. But year after year, it's a good place to have capital.
I always say that you need more than just the ones that you can triple your money in, because those are the ones that can go to zero. Zero, very bad. That's how you become poor. Now, you were always willing to say where things were. At one point, you told me there was overbuilding. At one point, you said there's overbuilding in Southern California, but the rest of the country's good. I need you to help me with data center. I know that you're perfectly willing to say if it's overbuilt. Do people know what they're doing?
Some people do, and many people don't. So it's everybody's favorite line of business these days, of course, to state the obvious. There's a lot of capital and plans and press releases that we see every day. But if you're asking me 10 years from now, will data centers be a pretty significant investable aspect of the real estate universe? I would say absolutely yes. Whether they will be growing at the rate that people project or not depends on a lot of things, including changes in technology. I mean, I'm not smart enough to answer that question, but will demand grow? For sure. Will technology grow even at a more rapid rate, thereby reducing the need for real estate? I don't know. We'll find out. But like everything, it's a good thing in moderation.
Okay, you've gone in, but not in the way that, say, an Oracle's going in, not in the way that I see a lot of the big hyperscalers going in. Do you think that some of these people this is not their specialty? Why would they know what they're doing? This is what you do for a living. It's not what they do.
Well, on the real estate side, building a data center is not that different than building anything else. It requires a lot of energy, but it requires entitlements, permits, the ability to execute on time, et cetera, et cetera. The technology companies know the insides better than anybody. They know the technology really well. But we know what it takes to get one of these structures up so that they can move their equipment into and get into business quickly. And I think increasingly having a strong balance sheet, having a strong brand, having a 40-year track record of performing for big global customers is going to be a differentiator. And like everything else, there's going to be an overinvestment and there's going to be a shakeout. I don't know when, I don't know how, but it always happens. And we certainly hope to be a winner in that business. If you look at history, we've always done better after a crisis because it sort of wipes out the field. And the ones that were, I guess, swimming with bathing suits come out looking pretty good.
Well, look, I want to thank you for everything you've taught us. I know when we're all getting old, when we're not going to be on TV anymore. It happens to everybody. But I want to thank you for your wisdom. And if you have a parting thought to us, please give it right now.
Jim, it's been a pleasure working with you. The only parting thought I have is that the public markets are an excellent way for individuals to gain exposure to the best businesses in the world. And it's ironic that we have a fraction of the companies that we had that are public today and that, private equity has taken over the world. And now we're talking about, of course, the everyday investors being able to access that business. Much longer conversation, but I think we should not lose of that transition that we're sort of giving up the most transparent way and efficient way of investing in the future of this economy to maybe a somewhat less transparent way.
Wow. Okay, that's a great cautionary note. And in the meantime, thank you for all the money you've made for shareholders in a very reasonable, I never felt you'd ever bet the farm on anything, which is kind of what we really need. That's Hamid Moghadam. He is the co-founder, chairman, and CEO of Prologis. Thank you. Thank you, Hamid.
Thank you.
Like I said, there's always a bull market somewhere, and I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.